Hey, Jason here. Today's video I'm going to answer the question, should you invest in REIT Stag Industrials? Stock ticker STAG. This is an investment analysis for Soul of the Game, who requested this on YouTube. Before I get to that though, I need to let you know you can get this video as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe and hit the notification bell here on YouTube so you're notified every time we release a new video, and releasing videos all the time. Okay, if you see my other videos, I apologize for this. I don't want to do this, but I have to do this because every time I forget to do it, I get nasty comments. I do not short sell ever, so any stock I talk negatively about, I do not profit off. I also do not own any stock in a long position that I talk positively about, so I don't benefit either way. I'm doing these videos at the request of viewers, you the viewers, to show you how to analyze stocks better, faster, more efficiently, to help you find great stocks, great potential investments faster. This is based on my preliminary analysis checklist that I developed over the last 15 years. And unless a company meets the certain criteria, the specific criteria we're about to talk about, I don't care about the story. I don't care about what its plans to do in the future. I don't care what its CEO says it's going to do. I don't care about any of that until far later in the analysis. At this early stage, all I care about is having a minimum margin of safety. That's pretty much it at this stage. So unless it meets that minimum criteria, I don't continue researching the stock further. Why should you listen to anything I have to say? First of all, there's a lot of people on YouTube you could listen to. Why should you listen to anything I have to say? In the first 9 years of my career, I've produced average annual returns for the investment portfolios I manage, of 23.5% per year on average, not compounded. That puts me just behind the great Warren Buffett in the first 9 years of his career at 24.2% per average annual return he produced for his shareholders or his investors. I'm not saying this to brag, but I'm saying this to show you that I actually know what I'm talking about a little bit, because these numbers legitimately make me one of the best stock pickers in the entire world over the last 9 years. Okay, again, hate doing that. Don't want to do it. Have to do it. I have to say this is for informational purposes only, and get that other stuff in there, because again, if I don't, I get nasty comments. So, let's get to the fun stuff now. Let's talk about Stag Industrials. Here we go. Back after a little bit of lag. Again, this is for Soul of the Game, who requested this on YouTube. Thanks so much for requesting this. I have not evaluated this company before, had not heard of them before. I do know they're a REIT because I looked down here, but other than that, I haven't evaluated this company at all, other than kind of seeing what they did. So I could put the information in the title. Okay, interesting. 4% dividend. That's very good. Makes sense with the REIT, with it being a REIT. Almost $6 billion market cap. Price to sales is high. I don't care about price to sales ever, but this is one sign the company might be overvalued. Consensus forward PE right here being unreadable is one sign the company might be unprofitable. We'll get to that in a little bit. Okay, business description. Stag Industrial Inc. is a real estate investment trust primarily involved in the acquisition and operation of single-tenant industrial properties throughout the United States. The vast majority of the company's real estate portfolio is comprised of warehouse and distribution buildings. Most of these facilities are located in Midwestern and Eastern U.S. states. Stag Industrial derives nearly all of its income in the form of rental income from its portfolio of warehouse and distribution properties. The company generates most of its rental revenue from its facilities located in the Midwestern and Eastern U.S. states. I feel like this is repeating. Stag Industrial's largest customers include air freight and logistics, automotive, and industrial equipment companies in terms of overall revenue. Okay, so before we get the actual numbers, I'm going to explain what a REIT is to everybody. In case you don't know, REIT stands for Real Estate Investment Trust. These are special tax entities, special legal structures, business structures in the U.S. and frankly throughout most of the world, that they get tax advantages, tax breaks, things like that, in exchange for that, and those things help them typically grow faster. Typically, most REITs through acquisitions, that's how they grow, and they can grow rapidly. In exchange for those tax benefits, tax breaks, stuff like that, they have to pay out they legally have to pay out 90% or more of their, I think it's net income, as dividends to their shareholders. If they do not do that, then they lose their preferable status. REITs can be a great way to invest in real estate if you don't want to find individual properties yourself. And it's a good way to earn high dividends, again, because of their tax status and their tax structure and their legally required dividend payments. They usually pay pretty good dividends as well. So a lot of people invest in REITs specifically for their dividends. Okay, so the revenue's gone up more than 10x in the last 10 years, from 44 million in 2011 to 499 million in the trailing 12-month period. That's fantastic growth. Their operating margin is fantastic. I look for anything above 10% on a consistent basis. I just realized I didn't have my microphone over here, so hopefully you could hear me this whole time well enough. I apologize for that, it's not in front of me. Their operating margin is fantastic. I look for anything above 10% on a consistent basis. Theirs is average, probably off the top of my head, around 22% over the last decade, which is fantastic. Net income for most of that time, for actually about half the decade, was negative, but negative only slightly. And in the last 5 years, it's been hugely positive. In the last trailing 12 months, their net income was positive $164 million. All that's great as well. Dividend has increased, about doubled in the last decade, from 73 cents a share in 2011 to $1.44 a share in a trailing 12-month period. One thing to note here is their dividend payout, their actual payout amount, is higher than their earnings per share. It's typically not a good thing. I don't know exactly what goes into the calculation for every individual REIT. To my understanding, for most REITs, it's purely based on net income. They have to pay out 90% of their net income as dividends. However, a lot of REITs, people invest in a lot of REITs specifically for their dividend. So a lot of REITs try to purposely raise their dividend ahead of earnings per share, so they can keep the shareholders happy and keep raising capital and keep issuing shares, which I can already tell they've done. Because that keeps shareholders happy. Again, most people that invest in REITs do so specifically not for the underlying assets, they do it for the dividend income. To continue enticing investors to invest, they continue raising the dividend, even if it's at a faster rate than earnings per share. Typically not a good thing, which we'll get to next when we talk about share count. Their share count has gone up drastically, almost 10x. Since 2011, from 16 million shares in 2011 to 152 million shares in the trailing 12-month period. Because that's a massive amount of dilution, I can almost guarantee that this company's share price is down over the last decade. And it's not, shockingly. Probably 95% of the time when you see massive dilution like this, share count or share price falls drastically due to the dilution of the shares, which I'll get to in a second. It's not happening here. My guess is, without knowing the intimate details of the company at this point, is that they're doing a pretty good job of allocating capital and earning higher and higher profits. How do I know that? Because their revenue has skyrocketed, their earnings or their operating margins are fantastic, and because of that, their operating income is fantastic as well. So they've been doing a good job, it looks like, of turning the money they sell from shares, or that they get when they sell new shares onto the market, turning that into profitable assets. Why do I say 95% of the time companies' share count goes down when they dilute a massive amount of shares, or when they issue a massive amount of shares and dilute shareholders? Because most companies do not allocate capital well. They issue shares or they issue debt and they just burn through the capital. It doesn't earn a high rate of return. Again, we haven't gotten to the other metrics yet, but just on operating income basis, operating margin basis, 28.4% on a consistent basis is fantastic. Again, I look for anything above 10%. So at least on that metric, They're doing a fantastic job with this capital they're raising to increase cash or to increase returns. However, if that turns and they start issuing shares and not investing that capital well, and their investment rate of return goes down, their share price would crater. Why? Again, think of rising share count as inflation. Over the long term, companies are valued based on their cash flows and profits they produce, and on a very basic kind of micro level, they're valued based on the per share profits and cash flow a company produces. The more shares there are outstanding, the lower per share value the company has, because the lower per share cash flows and profits the company has. Again, in this case, that's not the case, because they're increasing, or they're, at least again on operating income margin, they're producing very high rates of return. So that's why their share price hasn't gone down. But for most companies, that is not the case again. Okay. Free cash flow is also positive at 192 million in the last trailing 12 months. ROIC is okay. I look for anything above 10% on a consistent basis. It's been about 5% and above for the last 5-6 years. Before that, it was mostly negative or under 2%. So it's okay. Frankly, ROIC doesn't matter as much for REITs. They are valued a lot off of their cash flow from operations, CFFO, which I don't know if we're going to talk about today, frankly, because I don't know if it'll matter. We'll get to that point shortly. Okay, free cash flow to sales is fantastic. I look for anything above 5% on a consistent basis, and theirs is over the last decade, well, excluding 2012, and 2011, which were hugely negative. So the last 8-9 years is probably in the 15 to 20% range off the top of my head, and in the last 12 months it was 38.4%, which is again amazing. Their cash levels are low as a percentage of their balance sheet, only 0.4% of their balance sheet. Normally that would be a gigantic red flag. For REITs, again, it's not, because they have to pay out most of their cash to shareholders to keep their beneficial tax status. So it's not a huge red flag here. Also of note, they have a lot of other long-term assets. I would want to know what those are. Those make up 86% of the balance sheet. I would want to know what those are. They have a lot of long-term debt. Again, very, very common for REITs, because they either grow through issuing shares, issuing debt, or both. In most cases, their cash conversion cycle doesn't matter. Okay, let's go to the quarterly numbers. Go to the balance sheet. Okay. They have, again, not a ton of cash. They have, was that 80 million? Yeah, these are in billions. That's like 80 million. Actually, that was trade receivables. So they have like 20 million in cash, which again is not a huge red flag. Most for a company this size, what was the size again? 5.9 billion. That would be a semi red flag. But again, for REITs, they have to pay out their cash in many cases. They own a lot of properties, which makes sense because they own industrial properties, things like warehouses, manufacturing facilities, stuff like that. So they have to own a lot of properties. And that actually makes up most of their total assets. About, 80% of their total assets are in their properties, which again, makes complete sense. Current debt is low. They have about $230 million in current debt. Long-term debt is high though, 1.63 billion, and again they are a $5.9 billion company, so that's relatively high. Not crazy. That would be a bigger problem if the company wasn't as profitable, but the more profitable a company is, the higher debt levels it can have and sustain without having issues. So I wouldn't worry about that with this company, especially because it can obviously issue a ton of shares and issue debt. to raise even more cash if it needs to. Okay. Nothing else of major note there. Let's go to the cash flow statement. Okay, so this switched. This is now in millions, where the balance sheet was in billions. Okay, a lot of depreciation, amortization. Huge tax benefits to both of those in terms of real estate holdings. That's another reason REITs are so popular and can grow so fast, is because of the benefits of depreciation and amortization that real estate gets, which frankly it goes outside the scope of this video today. I might make another video of that at some point though. Okay. So in the last 12 months, they've purchased $700 million of properties, and they've sold about $200 million worth of properties. Again, pretty common. Nothing really of major note there. It's just more of a note than a red flag or a great positive or anything. More of a note. Proceeds from issuances of common stock. So they issued $266 million worth of stock in quarter 4 2020 and another $173 million in quarter 1 2020. Again, this is common not only for REITs, but this was common last year due to COVID for pretty much all companies, or most companies on earth. They issued debt to raise cash to build some kind of a reserve fund, just in case things got real bad. Proceeds from issuances of short-term debt. So they're issuing a ton of debt, but they're using a lot of that debt to pay off debt. Again, very common with a lot of companies now. Same thing with long-term debt. They've issued about $1.5 billion in debt in the last 12 months, and they've paid off about that same amount as well. Pretty common, especially with interest rates going lower for part of the year. So companies, if they can, issuing new debt at hopefully, preferably, lower interest rates, so they can pay off the higher interest rate debt with the debt. Again, not an optimal strategy, but it's pretty common in this arena for that kind of thing to do, or for companies to do that kind of thing. So not necessarily, again, not necessarily a red flag. From the looks of it, they pay about $55 to $60 million in dividends every quarter. And again, nothing really major red flag here either. So far they are a very clean company. Margins are fantastic, and they paid a good dividend. All things looking great. Let's see if that continues here, and it will not. So again, if you've seen my other videos, this is where most companies go to die for me, is the valuation, especially now with valuations being at or near all-time highs on pretty much every valuation metric you look at. I don't care much for PE, price to cash flow, or forward PE, but when I do, I want them to be under 20. PE right now is 35.7. Price to cash flow is 18.9. Forward PE is unreadable. Not really sure why, because they've earned net profits for a while now. Yeah, so I'm not really sure why that's unreadable, because that assumes that if it's unreadable, that it's going to be negative. So I'm not sure why that happens, but again, that's why I use my own metrics and calculate my own metric, because I don't know what goes into Morningstar's metrics. So I don't care much for these metrics up here. This one I do care about. This is one of my favorite valuation metrics, relative valuation metrics. Enterprise value to EBIT. I look for anything below 8 to consider the company undervalued. So this at 33.6 shows that Stag is overvalued by a wide margin. Not surprising, frankly, because again, people right now, if they are worried about valuations, which most people don't seem to be, because the stock market keeps going pretty much straight up, but those who are worried about valuations are typically buying dividend stocks, because there's nowhere else to earn a high return. Bond yields right now are low. Savings rates are pretty much, or they are negative after including taxes and inflation. So you have to put the money somewhere. which a lot of that is going to dividend income and or the general stock market, which is, again, another reason the stock market keeps going up as well. So Stag, I would not invest in Stag right now, only though because of its massive valuation. Otherwise, it looks like a potentially great investment. If you've owned it for a while, I would definitely continue holding it. But I wouldn't look to buy now due to its ultra high valuation. Other than that, though, looks like a great company, great potential REIT. Again, I used to own a lot of REITs. I don't anymore. I used to own a lot of REITs, so I'm very familiar with the industry, or with the industries. And I know they're hyper valuable, or can be hyper valuable, can grow rapidly, pay good dividends, stuff like that. So I'm actually surprised their debt levels aren't as high as I was expecting, frankly. Again, most REITs, especially with the craziness that's gone on last year, have struggled, especially things like mall REITs, some real estate, commercial real estate REITs, like office buildings, stuff like that, have struggled. But industrials makes more sense, more secure, because a lot of those, unless they were manufacturing facilities, probably didn't get shut down due to COVID, or have a lot of tenants not being able to pay, like mall REITs, stuff like that. So overall, good looking company, actually great looking company, but its valuation is just too crazy for me right now to invest in, especially with what I consider for my investors, the margin of safety I require for my investors and the portfolios I manage. Couldn't buy it right now, but if and when its valuation comes down, I will definitely take a look. I'll definitely add this to my watch list when the valuation comes down. So, soul of the game. Great stock here. Great looking stock here. If you own it already, again, looks like a great stock to hold. I wouldn't recommend buying it now because of its valuation only. Normally when I say I wouldn't recommend buying a stock now, it's because of other factors outside of valuation, like low margins, high debt level, stuff like that. On an initial basis, Stag is very clean. So just the valuation right now on that. Hope you like this video. If I didn't explain, if you did, let me know in the comments below. I'd really appreciate it. If I didn't explain something well enough. Again, hopefully I explained the share count, dilution well enough, because it's very important. If I didn't, let me know in the comments below. If you want me to look at a stock for you anywhere in the world, like I did for Soul of the Game, and like I have done, every single video I've done for the last 3-4 months now has been done at a viewer request. If you want me to look at a stock anywhere in the world for you, I will do so, but it has to meet 3 criteria. Cannot be a bank, because I don't evaluate banks. Cannot be an insurance company, because you actually have to dig into their annual reports to evaluate the companies. Has to be generating revenue as well. Why does that have to be generating revenue as well? Because I got some requests from people doing, they were requesting essentially startup companies that were producing zero revenue. The analysis videos were essentially useless because at this point, again, I don't care about the story. I don't care what it plans to do. It has to be doing something now, or I'm immediately going to discard it with my criteria. So if it meets those 3 criteria, I look at a stock for you anywhere in the world. If you're looking for more help on how to become a better investor, or actually, let me go back to that. That's later. If you're watching on YouTube, thanks so much. Make sure to like, love, share, subscribe, all that good stuff. And if you do subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you listen on the podcast, again, thanks so much. Do all that same stuff. We really appreciate it. But if you could also leave a review, that would be insanely helpful as well, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more help on to become a better investor faster, you can get a free PDF copy of my book, How to Value Invest, free copy of our guide, 7 tips to picking great stocks 3 times you must sell, and also 5 free gifts, including the actual written template for the visual part of this preliminary analysis we just went over. You can get the full worksheet for that, plus 4 other free gifts as part of our 5 free gifts, and you can get all 3 of these things for free at the links below in the description. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out information from our Value Investing Masterclass below this as well. But until next time, have a great day. Talk soon.